Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at supermicrocomputer.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis of supermicrocomputer. For our listener, if you want a stock that is probably the purest infrastructure play on this whole AI gold rush, this is it.
Yeah, this really is it. We're talking about a company that's, aggressively positioning itself right at the very beginning of the AI supply chain.
The high-performance servers, the boxes that hold the chips.
And the focus on AI is just, it's staggering. We found that over 70% of their sales in Q4 of fiscal 25 were directly tied to AI infrastructure.
Exactly. They aren't just dabbling in AI. Their entire business model is, it's fundamentally built on this boom.
Which has led to some truly phenomenal growth, the kind of acceleration you usually see with like a hot software startup, not a hardware company.
Oh, for sure. Looking at the financials, their fiscal year 2025 revenue came in at nearly $22 billion. $21.97 billion to be exact.
Which is a 46.6% increase year over year.
Yeah, a massive jump. But that's not even the big story here.
Right. What really captured everyone's attention and what's really anchoring this rally we've seen is the future guidance.
Management didn't just hint at more growth. They guided for at least $33 billion in revenue for the next fiscal year, for 2026.
That isn't just growth. It's a total step change in the scale of the company.
It's an aggressive target, and you really have to dig in to see why they're so confident they can hit it, and it really comes down to visibility.
Visibility meaning their order book.
Exactly. They're currently reporting an order backlog of $13 billion.
$13 billion. Okay, so this isn't speculative. These aren't just potential deals.
No. These are signed multi-year contracts with the major hyperscalers. That backlog gives them critical visibility for their ramp up.
And you have to look at the financial foundation that's supporting all this. They're maintaining a really healthy net cash position, low leverage.
Well, we're so crucial because growing this fast costs a ton of money.
Right. And that substantial operating cash flow they generate is what's letting them aggressively fund R&D and expansion without, constantly tapping the debt markets.
Which brings us to their competitive edge, the moat, so to speak.
Yeah, what is it? They aren't just building standard servers.
Not at all. They established dominance by being a first mover in AI-optimized platforms. But the real game changer, I think, is their leadership in advanced cooling solutions.
Okay, hold on. Isn't cooling just a commodity that everyone's trying to solve? If NVIDIA is controlling the chip design, how much real differentiation can Supermicro really have there long term?
That is the critical question. And the answer is all about engineering efficiency. They focus on density and power efficiency that, the legacy players just struggle to match.
How so?
Well, think about their commitment to things like 96% titanium level power supplies. What that means for you, the listener, is they're minimizing energy waste and therefore massive amounts of heat, better than almost anyone.
Ah, and in a giant data center, that translates directly to savings.
Millions on utility bills. And it reduces cooling infrastructure costs. They basically make the economics of running AI cheaper for their customers.
That makes perfect sense. So their innovation is actually creating long-term customer lock-in. It's their ability to integrate these cutting-edge components with rapid custom setups that has the big cloud providers choosing them over the slower, older suppliers.
Absolutely. And once an AI platform client commits to a multi-year rollout, that creates a very sticky relationship. You see those clients committing to expansion cycles, which ensures predictable, high-value, recurring demand. It's a fantastic position to be in.
Okay, that's the bull story, a very compelling one. Now, we have to flip the coin. This kind of aggressive scaling and market share grab has to come with massive risks.
It does. And the biggest concern analysts have right now is margin compression.
The bear case in a nutshell.
Yep. While revenue just exploded, net income actually slowed down a bit. It moderated to about $1.05 billion over the trailing 12 months. Profit margins are tightening.
Which isn't necessarily a bad thing, but it is a strategic risk.
Right. So tell us more about the strategy behind this. Is it just accidental costs piling up, or is this a calculated move?
It appears to be a calculated strategic sacrifice. Most analysts see this margin dip as a necessary digestion phase.
So they're sacrificing profit now to buy market share.
Exactly, to lock in revenue from these next-generation platforms. They're spending aggressively on capacity and scaling to meet demand right now before their slower, bigger competitors can catch up.
The theory being, if they win the platform wars today, the margins will recover tomorrow.
That's the bet. It's a feature of rapid scaling, but it definitely introduces risk.
And that clarifies the perspective. But we also saw real execution risk mentioned by management recently, specifically temporary order delays in their guidance.
Right. Which confirms that, the volatility and the supply chain pressures are very real when you're dealing with the world's most advanced components.
Absolutely, the supply chain is fragile. And speaking of fragile, concentration risk is enormous here.
Heavy revenue exposure to just a few large hyperscaler customers.
A handful. Yeah, so if one of those giants decides to pause or just tweak its AI CapEx cycle, you could see huge immediate swings in revenue for the company.
And finally, we can't ignore the regulatory overlay. The company operates globally, and they've acknowledged the ongoing changes in U.S. export controls for advanced semiconductors.
That kind of geopolitical uncertainty makes global supply chain planning much more complicated.
So we have a pure-play growth company managing very high risk for a potentially very high reward. Let's look at how the market is translating this into the technicals.
Technically, the stock is showing a lot of conviction from buyers. It's trading well above both its 50-day and 200-day moving averages.
Which tells you the sustained bullish uptrend is firmly intact, despite all the margin volatility we just talked about.
Right, and if we connect this to the bigger picture, you can see price action has consolidated really tightly near some critical support levels, specifically in that $45.50 to $50.30 range.
And those dips are being seen as buying opportunities.
By institutional money, yeah. It confirms their belief in the long-term story.
And we found some data in recent 13F filings that really jumped out. Leading tech-focused funds have significantly increased their positions. These funds aren't looking for a quick 5% pop.
No, they're signaling belief in the multi-year AI infrastructure rollout that Supermicro is driving.
But what's fascinating is the high volatility. We also saw that short interest is still elevated.
Which puts the stock in a perpetual short squeeze risk scenario if that critical February earnings report surprises to the upside.
That high short interest could just fuel a rapid, explosive move higher. The momentum is huge. Which brings us to what we need to watch over the next 3 months. What are the catalysts?
The immediate focus is all on the Q2 fiscal 26 earnings release. It's scheduled for February 4th, and this isn't just about hitting a revenue number.
The market wants to see margin recovery.
Absolutely. The market is demanding signs of margin recovery. Showing tangible progress, there will be a massive confidence booster and probably the next major price driver.
And beyond earnings, we've got the actual product ramp-up.
The ongoing deployment of servers integrated with the latest NVIDIA platforms, Blackwell and Hopper, and their new high-density plates. If they can execute on shipping these next-gen products faster than people expect.
That could drive a significant revenue inflection
Oh,
point.
sure. And don't forget the market mechanics. January 2026 has the major technology ETF quarterly rebalancing.
Right. Given their massive growth and market cap increase, their weighting could get a bump.
A strong possibility, and that automatically forces index funds to buy, creating passive inflows that can just mechanically push the stock price higher.
Okay, finally, let's talk about the speculative buzz, and this is where things get really interesting and potentially volatile.
There's definitely market chatter right now. It's suggesting a possible massive strategic partnership, maybe with a major Asian data center provider that's trying to rapidly scale up its AI.
Or those rumors of even more supply agreements with leading hyperscalers globally.
Yeah. And if any of those rumors turn into confirmed contracts, the resulting revenue boost and market validation would be huge. It would add a layer of upside that probably isn't fully priced in yet.
So to synthesize all this for you, the listener, Supermicro is undeniably at the center of the AI build-out. It's supported by a robust balance sheet, that first-mover innovation, and a strong $13 billion backlog. The growth potential is massive.
But the core investment thesis really boils down to two things. First, can management navigate the execution hurdles and supply chain risks of scaling this fast? And second, more critically, can they prove to the market that sacrificing margins now is a strategic choice?
The critical question for you to mull over is this. If their current margin compression really is a calculated sacrifice to secure long-term market dominance, are we just witnessing a temporary dip in profitability that could lead to an unassailable infrastructure monopoly in the coming years.
Keep a very close eye on that February earnings report and those execution metrics.
Don't forget to subscribe, like, and comment below to support Smart Wealth with Joshua. We'll be back tomorrow with another stock analysis.